What's going on, Penny boys and gals? It's Matt here, also known as What the Duck in the Discord, and welcome to class number 26 of our Pennybois University LITE series. Today we're going to dive into futures trading, starting with the fundamental concept: what exactly are futures contracts? Alright, so a futures contract is a standardized financial agreement between two parties. It's essentially a promise to buy or sell a specific asset at a predetermined price and date in the future. It's also legally binding, which means both parties are obligated to fulfill their end of the agreement when the contract reaches its expiration date. So you might be thinking, that sounds like an options contract. Well, it's similar, but there are some differences. With an options contract, you're buying a contract that gives you the right, but not the obligation, to buy or sell a stock at a specific price before or at a certain date. With futures contracts, the buyer is obligated to buy or sell the underlying asset at a specified price on a specified date in the future. Futures trading carries more risks due to this, especially if traders don't manage their positions with proper risk to reward management techniques. Whereas with options buying, the max loss is the premium paid for the option. Both are used for hedging and speculative trading. With both futures and options contracts, depending on the contract, settlement of your contract can be physical, actual delivery of the underlying asset, or cash, meaning cash equivalent of the underlying asset. With futures trading, you are not buying a premium, you are entering a contract. Traders deposit an initial margin as collateral to open a position. So day traders will buy a futures contract and then sell the same futures contract the same day. The difference in the price of the contract when they bought it versus when they sold it is the profit or loss. Many futures traders will use leverage to control larger positions with smaller amounts of capital. Of course, this brings more potential for gains, but also risk. So overall, futures trading is similar to options trading, concept at least, but it is different as far as the execution. Also, there is more risk with futures due to the obligation of the contract. Some people trade futures contracts, which is considered speculative trading. This is like day or swing trading, but with futures contract. There's also arbitrage trading, which is exploiting price discrepancies between related assets or markets. For example, if there's a price difference between a futures contract and the actual commodity, they will buy the cheaper asset and at the same time sell the more expensive one, locking in risk-free profit. Spread trading is another option for futures trading. This is buying and selling related futures contracts with the intention of profiting from the price difference between them. We have a PBU LITE class on spread trading, as well as advanced education available in our Discord. We also have a live options workshop every week. We also go over hedging in our classes, which is another strategy traders use with futures trading. Some traders will use the VIX futures contracts to speculate or hedge against market volatility as well. Futures contracts serve many crucial purposes. First is price discovery. Futures prices provide us with essential information about market expectations and future price movements. This helps investors and traders make informed decisions. There's also risk management. They act as powerful tools for managing risk. Businesses and investors use future contracts to protect themselves from potential losses due to price fluctuations in underlying assets. And of course, speculation. Traders utilize futures contracts to speculate on the future price movements of various assets. This speculative aspect adds depth and liquidity to the market. Now that we understand the essence of futures contracts, let's break down their key components. The first crucial element is the underlying asset. This is the asset that the futures contract is based on. It could be commodities like oil or agricultural products, financial instruments like stock indices, or even currencies. Next, we have the contract size. This specifies the quantity or units of the underlying asset that the contract represents. It's standardized to maintain consistency in the market. There's also the expiration date, also known as maturity date. This is the date on which the contract is settled and the underlying asset is exchanged. Finally, we have the contract price, which is the price at which the asset will be bought or sold when the contract is executed. Let's talk about some real-world examples of futures contracts in action. Starting with agricultural hedging. Imagine a wheat farmer who expects to harvest a crop in 3 months. To secure a stable price, the farmer can enter into a futures contract for wheat. This hedges against the risk of a drop in wheat prices before the harvest. There's also oil industry hedging. Oil companies often use futures contracts to protect against the volatility of oil prices. By locking in a future price for oil, they can better plan their operations and budgets. And of course, investor speculation. An investor believes that a specific stock index will experience a surge in the next few months due to favorable economic conditions. They enter a futures contract on that index, aiming to profit from the anticipated rise. There is currency exchange. Companies engaged in international trade may use currency futures to hedge against fluctuating exchange rates. This ensures they receive a fixed amount of their preferred currency when conducting transactions. There's also interest rate hedging. Banks and financial institutions may use interest rate futures to hedge against changes in interest rates. This helps stabilize their borrowing costs and protects against potential losses. As we get to the end of today's class, it's crucial to keep in mind the inherent risks associated with futures trading. While it offers potential for profit, it also comes with a higher level of risk due to factors like leverage and market volatility. Always remember to trade with caution, use proper risk management techniques, and never invest more than you can afford to lose. We have over 100 free trading classes in our Discord to help you further your education on these topics and more. I hope to see you there, but until then, as always, I hope that you all make some bread.